Well, good afternoon, everyone, and welcome to our end of financial year webinar for 2018. My name's Gavin Tiefel, and with me on today's webinar is Brent Rudderman. As we all know, June 30 is almost upon us, and we wanted to take this opportunity to go through some key points in relation to taxation opportunities, maintaining compliance, and also budgeting and forecasting for the new financial year. These are issues that are critical to every business owner, which is evidenced in the interest we've had in this webinar today. There's just under 90 of you on board. I'll now hand over to Brent and he'll run through what we're covering in our session this afternoon.
Thanks, Gavin. There are 7 key areas that we'll be covering this afternoon. These are the valuation of stock, the 20,000 instant asset write-off, making superannuation contributions tax effectively, the deferral of income, the writing off of bad debts, and the implementation of the new single touch payroll. In addition to this, we'll also run through some tips for budgeting and forecasting. As always, we value your feedback. You will see the feedback form pop up at the completion of the session.
Thanks, Brent. So the first topic we're covering off on today is stock take and stock valuation. Now, why is stock valuation so important? And there's 2 key fundamental reasons why a stock figure must be realistic. The first of these is to ensure that your financial statements as of 30 June reflect a real asset and profitability position. Overstated stock figures in turn overstate income and also the overstatement of your liquidity and equity position. The second reason your stock valuation must be accurate, particularly at June 30, is that this number has a direct bearing on your taxable profit and therefore tax payable. June 30 is a great time to reconsider your stock valuation to ensure that taxation is minimised. So how do we value stock? There's 3 key approved methods for valuing stock. Most commonly is cost, then there's market value, then also replacement value. We'll now step through a brief example just showing how these methods can be used. On the screen now is a very typical stock take and valuation like those that we see every day. So down the left you've got the product identification, then a column showing how many of them are in stock. Next is a column showing the method of valuation, and most systems will default to cost. As usual, the system will then multiply the number held by the cost. This gives us a total stock value, which is a very simple calculation. The spreadsheet on the screen now demonstrates how a combination of methods may be used. In valuing stock, it can be quite appropriate to use a mixture line by line of stock valuation methods. This is demonstrated in the stock valuation on the screen now. And it could well be that using a combination of methods like this could well make for a very different result. So it's very important to remember that a different valuation method can be used product by product. You may have an item in stock that you paid a full price for some time ago that's now worth very little. And in this case, it would be most appropriate to use the market value method for that product. It could also be that you may have a product that has been branded or customised in some way for a specific customer. And again, it may be best to use market value method for this, particularly if there's no guarantee of that customer purchasing the remainder of this stock. The critical thing is that the stock valuation method used is the one that delivers the smallest result for every line item, particularly at June 30, when a stock figure, as we've said, will be used for tax purposes. As we said earlier, this also ensures that the financial statements are correct. I'll now hand over to Brent to discuss the new $20,000 instant asset write-off.
So the $20,000 instant asset write-off provision. Now there's been a lot of talk about this since the budget, and much excitement about this being extended for a further 12 months to 30 June 2019. Now, this is good news. However, the budget has still not been passed by the Senate. So this is still not law. This means that there is still a possibility that June 30 this year could be your last opportunity to purchase assets and write them off in the year of purchase. So, what are some common features of the 20,000 instant asset write-off? Firstly, there is a turnover threshold of 10 million. If your turnover is higher than this, the concession is not available. Secondly, the $20,000 threshold is GST exclusive. So providing you can claim back the GST, purchase of assets with a ticket price of, including GST, of say 21,500 will be eligible for the write-off. The most common examples we are seeing are small utes with a price of $20,000 or less. The manufacturer of these will have done well from this provision. Computers and IT equipment, office furniture, warehousing equipment such as forklifts and racking have also been very common. We'd like to draw your attention to the fact that assets acquired under this provision must be separately identifiable. We have seen various cases where different components of assets have been separated in an attempt to repeatedly access this provision. In some cases, this may be appropriate, but in some, it is not. A common example would be a new excavator and an attachment. The attachment would often be a separately identifiable asset and could be sold separately to the excavator. In this case, it may be fine to apply the concession to the machine and the attachment separately. It is important to remember that an asset must be ready for use to claim the concession. This means that, say, for example, you ordered and paid for a new phone system on the 28th of June. If it isn't installed and ready for use by June 30, the concession can't be claimed until the following year. We would recommend seeking advice before acquiring assets with the intention of using this provision. In closing, we'd also say that it is wise to think about your overall financial and tax position before purchasing assets with a view to writing them off. As always, it makes no financial sense to purchase an asset or to spend money simply to save tax.
Thanks, Brent. That's good. So the next area that we wanted to look at is that of bad debts. I'm sure most of us would have accounts on our list of accounts receivable, which we know that there is very little chance of ever collecting. There is some provisions around when these debts can be written off. So we certainly recommend seeking advice around this. However, some key concepts apply. The first thing we need to realistically consider is the question of, is this debt really recoverable? If not, it should be written off. Secondly, the circumstances surrounding the debt also need to be considered. Could well be that there's certain reasons that you as a business owner may decide that a debt can't be pursued. But the main thing is to look at your receivables list realistically and to write off any debts that you do not believe you will be able to recover. Lastly, remember that if a debt is later recovered, you can always re-invoice the customer at a later point. The next point for discussion today is making superannuation contributions. And I'll hand over to Brent to take us through this.
So a tax deduction can be claimed for amounts contributed to superannuation that are regarded as concessional contributions. The maximum amount for these concessions this year is $25,000 per superannuation fund member. If you are looking to make an additional contribution to super prior to June 30, please remember that this $25,000 cap includes any superannuation paid on your behalf through your employer or payroll. In working out how much you can contribute, the total of employer contributions has to be taken off the $25,000 cap. One very critical component of making a contribution to superannuation is timing. The ability to claim a tax deduction for superannuation arises at the point that the contribution is added to your account by your superannuation fund, not at the point at which you make the payment. Where you are making a contribution to a large superannuation fund or to a retirement savings account offered by a bank, there can be a significant delay between when you make the payment and when the bank or super fund allocate this to your superannuation account. The main takeaway from this is that timing is everything when it comes to making superannuation contributions. One strategy that may overcome this in some way is to revert to the old-fashioned practice of using cheques for making superannuation contributions, if you still have a chequebook. Although cheques are rarely used these days, the tax office still accepts that if a cheque was drawn prior to June 30 for a superannuation contribution, and it was presented as soon as practical after June 30, that the contribution belongs to the previous financial year. In other news relating to superannuation, the tax office have announced an amnesty for businesses who have employees and haven't paid superannuation for them or haven't fully met their superannuation obligations. This amnesty runs until 30 June 19. The main feature of this is that employers can make catch-up superannuation payments on behalf of their employees and claim a tax deduction for this payment. Previously, employee superannuation that was paid late would attract penalties and was not a tax deduction. We would highly recommend that you take this opportunity to ensure that your employee superannuation contributions are up to date.
That's good, Brent, and certainly an opportunity we hope anybody in that category takes advantage of. The next point we'd like to discuss is that of deferred income. All too often we regard our business income or sales for a year to be the total of invoices we have raised. In many cases this is correct, but it's always wise to consider whether any of this income can be deferred. Now there's two key tests that relate to this. The first is whether income has been derived, and secondly, is the income refundable? Around this time of the year, it's very common to be given an order from a large company or possibly a government department, which may need to be invoiced prior to June 30. In cases like this, although the order's been invoiced, the income may not have yet been derived because products ordered may well have not been delivered. In this case, it's possible that the income could be deferred to a following year when the products or services have been delivered and the orders fulfilled. The second test in this is whether the income would be refundable to the customer. There may be many situations where goods or services are invoiced up front and will be delivered over time. In these cases, if the relationship with the customer terminated at June 30, the income relating to the undelivered goods or services would need to be refunded. This is an indicator that as at June 30, this isn't yet income. Again, we'd certainly recommend seeking advice in relation to this, but there may be situations unique to your business where some income could be deferred to the next financial year. I'll now hand over to Brent to discuss the topic of single touch payroll.
A quick poll. Who is looking forward to finalising and distributing their payment summaries for all their employees for the current financial year? The results are in already. No one. Thankfully, from 1 July 18, there is changes coming for those businesses with more than 20 employees. Single touch payroll. All you need to do is make sure your payroll software offers single touch payroll and your staff understand the process. This new process simply means that all wages and super will be reported to the ATO in real time, and once a finalisation declaration has been made, there will be no further need to provide your employees with a payment summary. Instead, your employees can simply review their tax information through their MyGov account. Again, this only applies if you have more than 20 employees. This will also apply to everyone else from 1 July 2019 in 12 months' time. Our team are more than happy to assist anyone who would like more information on this.
Thanks, Brent. That's a good overview. So our final point of consideration today revolves around budgeting and forecasting. While 30 June may be a good time to review your numbers with a view to managing tax and analysing history, the new financial year also represents an excellent opportunity to revisit budgets and to update forecasts there's certainly nothing wrong with new financial year resolutions. The first step in this is a question of, do you have a budget already? If not, new financial year is certainly a great time to start. A budget can be a very simple document, and we're always glad to help you with this. And if a budget has been in place, June 30 is an excellent time to review it and to analyse variances. In doing this, you may well identify areas of expenditure which are not within budget. New financial year is a great time to look at this and to take corrective action. The next step in budgeting for the year ahead is to consider sales and overheads. It's very effective to do this line by line, category by category, drill into the detail of it. And if in doubt, you always have the previous year's numbers to use as a starting point. The main thing with a budget, particularly when it comes to sales, is that it needs to be a stretch, but by the same token, it must be realistic and revisited frequently throughout the year. So I'll now hand back to Brent to give us a quick summary on what we've learned today.
So what have we learned today? Firstly, we've learnt about stock valuation and the difference that the method of stock valuation can make. It is essential that stock valuation methods used results in the lowest stock figure possible. Secondly, we've learned about the $20,000 instant and how it is available until June 30. However, we cannot guarantee it will be available for the 2019 financial year at this stage. Thirdly, we have learnt about the managing bad and doubtful debts so that we don't pay tax on income which we are never going to receive. Fourthly, we have learnt about superannuation contributions and the importance of getting the timing right. Fifthly, we have learnt about the deferral of income and whether you may have income for the year ended 30 June, which may be able to be deferred until the next income year. We've had an update on the single touch payroll, which will be coming into effect on 1 July this year. And finally, and most importantly, we've learned about the importance of viewing your budget and capitalising on the beginning of a new financial year to reset your budgets looking forward. I'll hand over to Gavin to finish off.
Thanks for that overview, Brent. So that really brings us to the end of today's webinar, and we hope you've found it useful. Once again, we value your feedback. If you could complete the feedback form at the end of this session, it would certainly be much appreciated. As a token of appreciation, we'll send you a copy of our profit planning tool. This is an excellent tool to use to map out your plan for the next 12 months. As always, we are a team who believe in looking ahead. So get your copy, and if you'd like assistance in making your 2019 financial year your best year yet, we are always here to help. We'd like to thank you for joining us today. Many thanks and good afternoon.